As of today, Saturday, January 24, 2026, the stock market is currently closed. Nuburu Inc., trading under the ticker BNUR on the NYSEAMERICAN, finished its most recent regular trading session on Friday, January 23, 2026, at a price of $0.1912 per share. This represents a solid intraday gain of approximately 1.92% from the previous day's close of $0.1876. During that final session of the week, the stock showed significant volatility, reaching a high of $0.2012 before settling back down, while maintaining a floor at $0.184. Interestingly, even in the after-hours session that followed, the stock saw a slight cooling off, sliding by roughly 1% to sit at $0.19. This slight late-night dip often signals a tug-of-war between the retail crowd, who are reacting to the flurry of recent defense sector headlines, and the institutional side, which is busy digesting the heavy dilution that has hit the tape recently. While most traders are looking at that sub-20-cent price tag and seeing a penny stock struggling to stay relevant, the reality beneath the surface is that Nuburu is currently executing a high-stakes pivot that almost no one saw coming 6 months ago. The general expectation from the market has been that this company was a pure-play industrial laser manufacturer destined to fade away due to a lack of revenue. However, the reality we are seeing in January 2026 is an aggressive move into the defense-adjacent software space. By securing operational control of Orbit SRL, a software-as-a-service company focused on operational resilience, Nuburu is trying to fix its biggest problem: lumpy, unpredictable hardware sales. They are essentially bolting a recurring revenue model onto a hardware company. This creates a massive disconnect between what the average investor believes, that this is a dying laser firm, and what the management is actually building, a dual-use technology platform with steady SaaS cash flows. When you look at the recent trading volume, it tells a story of intense interest. Over 56 million shares changed hands in the last session alone, which is well above the 3-month average of around 39 million. This spike in activity isn't just random noise, it's a direct response to the company's recent execution month. In the span of just a few weeks, we've seen the Lyocon acquisition close and a strategic alliance with Tekne in Italy get activated. For a company that was reporting trailing 12-month revenue as low as $9,300 not too long ago, these moves are a desperate but calculated attempt to scale. The market narrative says Nuburu is a high-risk gamble, but the recent price action, staying remarkably resilient around the $0.18 to $0.19 level despite massive share issuance, suggests that a new floor might be forming. If you are using tools like Schwab Intelligent Portfolios or other online investment platforms to manage a broader strategy, a stock like BNUR usually won't show up on your radar because it's too small and too volatile. However, for those of us doing self-investing and looking for investment help in the small cap space, the institutional activity here is the real hidden gem. Despite the low price, we're seeing names like the Vanguard Group and Geode Capital Management actually increasing their positions. Vanguard, for instance, has bumped its holding by over 95% recently. When the big players are adding to a position that most retail investors think is an avoid-at-all-costs situation, it forces you to rethink the risk-to-reward ratio. Are they just tracking an index, or are they seeing the same SaaS pivot that the market is currently ignoring? The institutional confidence score might be low across many investing sites, but the actual accumulation data shows that the smart money is holding on to about 6 million shares. This is happening while the company is under a massive dilution phase. There have been reports of tens of millions of new shares being added to the float in just the last few weeks to fund these acquisitions. Usually, that kind of supply would send a stock into a death spiral. Instead, BNUR has been trading sideways to slightly up. This indicates that there is a massive amount of buying power absorbing that dilution. Someone wants these shares. Comment below how many shares of Nuburu you currently hold, and if you think this pivot into defense software is actually going to save the company, or if it's just a distraction from their core laser tech. To really understand the tension here, you have to look at the macroeconomic pressures. We are in a climate where defense spending is top of mind for every major government. Nuburu's blue laser technology, which is 8 times faster than traditional methods for welding metals like copper and aluminum, is a perfect fit for electric vehicles and defense sectors. But the market has been skeptical. The common ground among critics is that Nuburu has a cash runway problem, and they aren't wrong. With a net loss of over $55 million recently, the company has been surviving on convertible notes and equity offerings. This is where the Robinhood stock trading crowd often gets burned. They see the blue laser hype but miss the balance sheet reality. However, the contrarian take is that the Lyocon and Orbit deals are specifically designed to bridge that cash gap by bringing in immediate high-margin revenue. When you look at investment help through a Fidelity brokerage or using the Fidelity mobile app to check your Fidelity IRAs, you'll notice that BNUR is a far cry from the stability of something like Nvidia stock or Apple stock. Those are the titans that anchor a portfolio, while a company like Nuburu is a high-conviction bet on a niche technology. But the intelligent portfolio approach suggests that even a small speculative position can be justified if the catalyst is strong enough. The catalyst here is the transition from development stage to revenue-generating platform. Management has been very clear about this. They are no longer just a research lab, they are now an operating business with a $20 billion global industrial market in their sights. Let's talk about the business model for a second, because it's changed dramatically in the last 30 days. Originally, the plan was simple: build the best blue lasers in the world and sell them to manufacturers. The problem? Manufacturers are slow to adopt new tech. So, Nuburu changed the game. They started acquiring the companies that actually use the lasers and the software that manages the systems. This is what the Orbit and Tekne deals are all about. They are building a moat around their technology by owning the ecosystem. This is a much more sophisticated strategy than you'd expect from a company with an $80 million market cap. It's the kind of move you'd expect from a much larger player, and that's exactly why the volatility is so high. The market doesn't know how to price a penny stock that's acting like a mid-cap conglomerate. For those of you using SoFi Invest or Interactive Brokers trading, you know that execution risk is everything. Nuburu has promised a lot for 2026. They've talked about re-establishing their industrial platform and hitting multiple defense milestones. If they miss even one of these, the stock could easily test its 52-week low of $0.12 again. But if they hit them, if that SaaS revenue starts showing up on the 10Q filings, the gap between the current $0.19 price and the 52-week high of $0.85 begins to look like a massive opportunity. It's a classic case of expectation versus reality. The expectation is a failure to integrate these acquisitions. The reality could be a streamlined, high-tech defense contractor. When you look at the sector momentum, the industrials and defense sectors have been outperforming. However, BNUR has been an outlier, down over 51% over the last year. This creates a coiled spring effect. Most of the sellers have already left. The people remaining are the diamond hands and the institutions. This is evident in the fact that the stock hasn't collapsed despite massive new shares being added. In Fidelity trading platform, you can see the technicals are showing a stock that is deeply oversold on the long-term charts, but starting to show a bullish divergence on the daily RSI. It's trying to wake up. We also have to consider the risk of a reverse split. In the past, Nuburu has used a 1-for-40 split to stay compliant with NYSE American rules. Investors are naturally wary of this. They see the current price under $1 and think another split is inevitable. This fear is what keeps the price suppressed. But if the company can use its new revenue streams to push the price organically back above $1, that fear evaporates. This is the reality that could catch the short sellers off guard. There is a high level of short interest in these micro-cap tech stocks, and a single positive earnings report showing actual revenue could trigger a massive squeeze. For the person doing online investing through an individual brokerage, the takeaway is that Nuburu is no longer the company it was in 2024. It has fundamentally restructured its debt and its assets. It's a much more complex animal now. Whether you're looking at SoFi ETFs or